Alrighty, so now that we have installed the indicator and we know how to mark our session liquidity levels, let's go over the entry model. So we'll start off first by just going over quickly how a standard fair value gap works. We look for a 3-candle formation. It has to be 3 candles. Fair value gaps are not created with 2. On the bearish, we have 1, 2, 3. On the low of the bearish candle, we want to mark out the wick, skip a candle, then the next candle, we want to mark out the high. And then in this area is a fair value gap. All this means is that clearly sellers were in control and no buyers stepped in, which is why we have a gap in the market. Now, inside those fair value gaps may be stop losses from another area, pending orders that are waiting to be filled, etc. So on any normal trading session, what we want to see with a fair value gap is it to be respected. And to determine how you're picking the right fair value gap is this model that I look for. Usually people will get in an entry as soon as a fair value gap gets tapped into. But why risk it? Because for all you know, the next few candles can end up disrespecting this, and then you've instantly lost a trade. This is where patience plays and patience pays. So basically this will happen all of the time. The third candle, which is our third displacement candle that's caused the gap, is going to leave some sort of swing point. Now, if we go by just the narrative that all wicks, no matter what time frame you're on, are going to have the strongest parts of liquidity there, which is why you'll always see a sweep. So like, for example, say this low got swept and we didn't keep going down. This is a clear indication to look for the opposite direction, because this candle swept it and now we're trading up away from it. Now up here could be again Asia high or London high, whatever the case may be. Could just be a standard 15-minute swing that has no real significance, but it aligns with the bias that you're going to trade to. So on the third candle that causes the fair value gap, I always mark out the swing point. So this will be, in this case, the low of the candle. In a bullish, it would be the high of the candle. To know with a better probability that the fair value gap you're working is going to be respected, I just wait for these key things. Now, this could happen over 10 candles, but I probably wouldn't be interested by that point. If momentum is strong, I want the fair value gap to be created, a candle to ideally come inside of it. That's what she said. And then I'll mark out that previous candle. That is now the previous candle which has tapped into the fair value gap. So we want to wait for the next candle to close below around this area, but without taking this swing point, since this is the key candle that caused the gap in the first place. So if this has a lot of liquidity, and again, on higher time frames, there's going to be more liquidity there because this is where price stopped. Whatever buyers were pushing now have all of their stop losses below, which will be a target for later. So in this example, the first candle that tapped into it is going to be step 1. We then want the next candle to come into it. And again, if the gap would be respected, we'd have another candle probably close outside of it, indicating that we should now be looking for bullish plays. So all we've done is just waited for the next candle to come in. And again, we've marked out the previous candle high. In this case, it's the candle low. Now, this is why marking this is important, because we want the very next candle, ideally, to close below this, indicating that this gap is now being respected, because there's a high chance that it's grabbed whatever liquidity was inside, and now we're going to be aiming for these. And obviously this is only minor at this point in time, but further down on the chart could be London low, for example. So as soon as we get that closure, we want our stop loss preferably underneath the gap. It would be here on a bullish example. And I want to target 20 points. 20 points on NASDAQ is where all of my data comes from and what this model is based off. Now, obviously with session liquidity, you can obviously hold for more points. But if we know that price is generally going there and we want to be in and out of the market, especially as scalpers, take the 20 and run. And with the higher probability of a 1-to-1, that's where you can risk more. You can put in 2 minis, 3 minis. Whenever I'm taking a trade, I'm not thinking about the value of the trade. Everything is based on points. If I know with gold that 10 points on average will get hit, and I know that I'm only risking maximum 5 points, and I can trail quickly to 2 or 1, why not go in with 2 contracts? It makes no difference if you were trading with micros or minis. The trade idea is still the same. It's still based on points. The market doesn't care how much you're putting into it at the end of the day. So with that being said, what also determines the entry is going to be first, before we take this setup, we want a gap to actually be inversed. So we want a candle closure above here, because what we're waiting for now is for a new fair value gap to be created and respected. And that is going to give us the extra confidence that price is going in that opposite direction. Because if we were truly bearish, we wouldn't be trading above this level. And that's what the indicator is doing. It's calling a fair value gap that gets inversed and then a new gap created that will be respected. And this is the entry model. So we'll go over it on an actual chart example right now.